this hour, we are joined by Silicon Valley VC Bruce Cleveland of Wildcat Venture Partners. He's got a new book out, The Traction Gap. Really cool. So much to talk about because the Miami scene in South Florida is really exploding from startups, technology, all that. We're talking about, what other areas in America can kind of grow and somewhat replicate that Silicon Valley success. And that really was what I was doing with America's Venture Capital, the conference up here in DC, in the region, Northern Virginia, Baltimore, Maryland, stuff, as my wife and I sort of wrap up our schooling at Johns Hopkins. We're both doing graduate degrees there, and I also have my law degree. I'm doing an MBA, Master in Communication. My wife is doing a Master in Public Health and an MBA, and I have a law degree from Berkeley, and my wife's got a medical degree from Italy. Now, here's the thing. Bruce is going to join us probably in about 15 minutes, and this is going to be fascinating. This is someone who literally was almost, I'll let him tell the story, but he's met Steve Jobs, Tom Siebel, some of the heavyweights. This dude knows the situation, and he's very good. So I think you're going to really like that. If you're into business, if you're into startups, you definitely want to listen to that. But before that, I want to talk a little bit about something, and this is a little bit of a Byzantine subject if you're not up into it, but I'm going to try to make it as simple as possible. It's kind of what I did on my YouTube. I have a lot of YouTube videos. I've got well over 50 million views on my videos, and I have different series. And one of my series is Ask a Super Genius, and that's kind of where I take complicated subjects and try to make them simple. And I'll do a run of them, and then I'll kind of give it a rest for a while. And this is kind of one of those types of topics. And we've seen some news here about the economies. We're on the verge of recession. To me, this is all hype. And Rush did, I think, a great job on his show. And in my opinion, he's the best broadcaster out there. And the numbers sort of prove that. There's other people that are good too, but I think he's the best. So I like listening to him from a broadcast perspective, just technically what he's able to do. I'm not going to impugn motives. I'm not going to say, I think Rush on his show was saying this is a dry run and this is the media scene. If they can, you can listen to his show and stuff like that. I'm not going to go there. I'm not saying he's wrong. I'm just not commenting on it in that way. But I will say that I'm very comfortable saying, in my opinion, that a lot of the media seems to be, not super friendly to President Trump. And I think that a lot of media people, unfortunately, don't have a tremendous expertise when it comes to financial and economic matters. And I think that that's also something that, and I've been arguing this for so long, that we need basic economics and basic finance in the schools, right? And in colleges and definitely in high school and stuff like that. That's not required so many places. I think that's starting to pick up some steam, and I think that's important. But we saw all these things about all the recessions coming in, the inverted yield curve and all these types of things. And, like the sky is falling. Meanwhile, all the metrics are just exploding. Wages are up, unemployment's down, GDP is still positive. To have a recession, technically, you need 2 quarters of negative GDP. We haven't even had 1 quarter. So everyone's talking about the sky is falling. Now, at some point, some way, somehow, I'm sure there will be another recession and a dip and stuff like that. Again, we are in, as I said last week, I didn't look it up, but I'm almost positive we're in the longest, if not the second longest, expansion in America, economic expansion ever. And nobody predicted this. People were talking about when Donald Trump was saying, hey, we'll do 3%, GDP growth, which is huge, right? In the modern times. And there's been arguments like, oh, you can't do that. You can't get, I think President Obama was talking about you can't get above 2% GDP or something like that. This is a paraphrase, in my opinion. I may be wrong, because it's different times now and stuff. And there's all that's even a longer argument. But basically, no serious people were talking about, no serious experts that I saw in any kind of volume. How about that? I'm sure there's always 1 or 2, whatever, anecdotal stuff. But I didn't see any volume of experts that were saying that what Donald Trump was saying about 3% GDP was possible. And yet here we are And it may be, we're with revision slightly below, slightly above, whatever, but we're right there, right? And it's still going. And so all these cries last week of, the sky is falling, recession's here, and all that type of stuff, because of this, one of the reasons was the inverted yield curve. And I don't think we're anywhere near. And then you had Bill Maher out there who, on his program, if I remember correctly, if I saw it right, in my opinion, was saying that he was hoping for a recession to be able to defeat Donald Trump. And I think that's the rub, right? Because Trump is doing so well in his administration with the results of the economy. And if they could pass the USMCA, which is sitting there, in Nancy Pelosi's house, that would help even more, which is the new trade deal between Canada and Mexico that Trump hammered out that seems to be much more favorable to the U.S. than, in my opinion, than NAFTA was. And so all these things are working really, really well. But last week we had a hit in the stock market, and there are certainly issues with the trade stuff going on with China, and there's certainly issues with the global economy. We're going to talk about that in a second. And this yield curve went inverted, and that has traditionally been a measure, in my opinion, a metric to look at what could happen. And that's basically the bond market, which is debt, saying, hey, we think that yields, that basically rates are going to go down in the future, far out in the future, more so than now. That therefore that's sort of this gloom and doom, there's clouds on the horizon. We are, concerned about the future. So if you look at the yield curve, basically means that you have, if you were to plot a chart, you have 1-year rates, 3-year rates, 5-year rates, 10-year rates, 30-year rates, and I'm not giving anybody financial advice, legal advice, any other kind of advice whatsoever. I'm just a radio host, and we're just talking opinion, right? So if you look at these things, you would normally say that, okay, because of the risk, time value of money, all these types of stuff, if you get paid back in a year, that's less risky than if you get paid back in 2 years or 3 years or 5 years or 30 years. Therefore, you will have, under normal situations, rates that go up. So a 5 year is going to be a higher rate than a 1 year. A 2 year is going to be higher than a 1 year. A 5 year is going to be higher than a 2 year. A 10 year is higher than a 5 year, etc. And therefore, you have this sort of upward sloping yield curve. That's what that means. If you were to put sort of a line, a curve with all those rates as you go out in the years, it will slope upward. When it slopes downward, aka inverted, that means that the 30-year rate or the 10-year rate is below the 5, 2, or even 1, right? And that happens when there is a guesstimate by these bond traders, and these are global markets now, right? Feel like there's more risk, well, rather, that rates will go down further out, or there's risk to the economy and stuff like that. So what we saw back in the Great Recession, right, is that you had negative rates over there in Europe, where basically the cost, where if you had money in the bank, you were kind of losing money against inflation, or even, yeah, exactly. And so, and there is maybe even talk about negative rates now. And again, I'm not totally on point with all this stuff right now, but I'm hitting the broad strokes that I do know, in my opinion, what I'm talking about. So what does that mean? And is that applicable now? Now, I think there's some big macro trends that are happening in the global economy and the U.S. economy writ large that has a different impact. And I've been arguing that for a bit now, that with productivity and automation and AI and these things coming, that you can have growth without the inflation as we have traditionally seen in the past. And I think that's borne out. But also what I saw recently on CNBC was, bond super expert Mohammed El-Arian. He said something that I also thought was very important, and I would highly recommend that everyone go check this out. And he said something to the effect that, look, the U.S. is doing fine. It's the rest of the world that is suffering, a slowdown. And so what that means is, as the rest of and this goes into trade, and it goes into economy, and it goes into Trump, and it goes into all of it. Here's why. Here's how. Okay. We have this trade situation going on. There's a lot of countries like China and even in Germany that are heavily export focused. And there's others, obviously, definitely. But, Germany's heavily dependent on their, export of autos and other stuff like that. And if you're heavily dependent on exports, and now all of a sudden you've got these tariffs put on, that is very, impactful to your economy. So one of the things that these countries could do to sort of offset that is to try to lower their exchange rate, devalue their currency. Because if you have roughly $300 billion in tariffs that are put on by, the US and Trump, but you're able to devalue your currency by about the same amount, then you're sort of at the same spot. But one way to devalue the currency is to lower rates. So as you lower rates internally, right, through different mechanisms, depending on the country and depending on how you want to do it, as you lower rates, it devalues your currency, but now your rates are lower. So what happens? What happens is these are global markets. So if I'm a bond investor and I'm there in Germany, and I'm just throwing out fake numbers here, but if I was getting 2% on my money, and now I'm getting 0% on my money, I don't like that. I want to dump out of that. I'm going to go to somewhere else that has an equal or maybe even better risk profile with a better return. You're always chasing less risk, more return as an investor, in my opinion, right? And so now I cannot invest. I'm getting a 0% return. So I see the U.S. over here. Oh, okay. Then the U.S. they're getting 3%, whatever it is, 1.5, 2%, something. So I'd rather get 1.5 or 2% than 0%. And the U.S. is at least right now, actually, the U.S. is less risky than Germany, in my opinion. So you have this flood of money that comes in, and it's going to hit these longer. There's just more demand right now on these longer term instruments, and that supply and demand. So as you have more demand for these bonds, the rate goes down. Right? I hope I'm getting this right. I'm pretty sure I am. Sometimes you have to cross-reference a textbook because the way you talk about things is sometimes flipped in terms of the debt stuff. And I have a number of professors that are bond experts, so they may call in, and that's fine. But roughly broad strokes, that's what we're talking about. And what Mohamed El-Erian said, and as I said, is that look, it's because these other countries are getting hit by tariffs and they're slowing down. So one of the things that we saw here with the Great Recession is what did we do? We did QE, quantitative easing. We're basically pumping money and lowering rates, pumping money, making debt less expensive here, lowering the debt service burden on everyone really. Student loan borrowers, home borrowers, mortgage rates, corporate debt, all that type of stuff. So that's a way to stimulate the economy. So it's the dual need of being able to trying to fight the tariffs from Trump and also trying to stimulate their economies, especially if you're in export-driven economies, that has been driving these low rates globally. And that then has spillover and impact into the U.S. because we are a global market. The money can move all around the world, and it does. And therefore, what Mohamed El-Erian is saying, I believe, in my opinion, is that this time could be different. Yes, you have an inverted yield curve, but that is because of the strength, not the weakness, because of the strength of the U.S. economy. And that is very different. And so if that is correct, which I believe that it is, then you have to look at Trump and the performance of this administration and say, wow, that is incredible. That is incredible performance in the face of this global slowdown. And so that should get you thinking. And so we've seen things that are different. We've seen, rules that are broken now, and we see something that's working. And I think that, whatever your politics are or whatnot, you have to look at these last 2-3 years where, economically, politically, different things, the rules have been tweaked, adjusted, rewritten, Conventional wisdom has been run against, but it's been so successful from a performance standpoint. Now, you can vote for whoever you want. You can say, I don't like what Trump says, and that's all fine. But I think that we all have to look at these things and we all have to educate ourselves, right? Because all these issues are very important, and there's some big macro things going on. And there's so much that we're going to talk about with here soon with Bruce Cleveland of Wildcat Venture Capital. But I kind of love his take on